降500万，暴跌。上海的楼市近期不断的刷新下限。上周复兴中路房租暴跌的原因归咎于老外离开的视频爆火。昨天刷爆朋友圈的不是房租，而是世贸滨江的房价暴降500万，单价竟然不到10万，火爆了整个豪宅经济圈，割了500万呀！从市场价2800万直接降到2300万，割肉近20%。还有人和滨江园降400万，仁和和平城降350万，喜悦园降200万，汇浩天下降200万，这就是近2个月的事情。
China's real estate market began to show signs of cooling, with even Beijing and Shanghai feeling the chill as property prices fell to the lowest level since the surge in housing prices over a decade ago. Miss Yi, a 31-year-old resident of Shanghai, was able to offload her suburban property for a mere 4 million yuan in April, a staggering 11% lower than her initial asking price. A development that took her by surprise clearly favors the buyer, making it a challenging task to attract potential purchasers. Among China's 4 first-tier cities, the price of a second-hand home in Shanghai saw the largest month-on-month decrease in May, down 0.8%, followed by Beijing at 0.6%, while Guangzhou and Shenzhen saw more modest decline of 0.2 and 0.18%, respectively, as they had already experienced significant drops in April. Data from Centaline Property in Shanghai shows that asking prices for homes have fallen for 3 consecutive months, hitting the lowest level since the lifting of the lockdown. Canadian financial company Power Sustainable Shanghai Investment Management has also noted that homeowners in Shanghai seem to have reached a consensus that the market has peaked and prices are on a downward slope. As for the volume of transactions, there were only 16,000 second-hand homes sold in Shanghai in May, a third less than in March. However, the number of homes listed for sale in May surged to a record high of 520,000, an increase of 120,000 in a single day. Multiple homeowners such as banker Mr. Song began reducing their real estate exposure, considering the possible imposition of property taxes and a potential downturn in prices. In May, Mr. Song sold his apartment in Shanghai's Jing'an district for 10 million yuan, about 1.4 million USD. Suggesting that this was the final window of opportunity to cash in on the real estate boom. Additionally, expatriates in Shanghai have begun to exit. In early 2022, Shanghai had a quarter of China's foreign population, but according to a report by the European Union Chamber of Commerce in Shanghai, a quarter of Germans living in Shanghai have left by the beginning of this year, while the number of French and Italian citizens fell by 20% each. This led to a 15% to 20% decline in housing prices in the Lujiazui district in the city center, where many expatriates and financiers reside, from the historical peak in mid-2021. In the luxury home market in Shanghai, prices in Huangpu district, the business and cultural center of Shanghai, fell by about 10% compared to the same period last year. In the bustling Xuhui district, luxury home prices fell by about 7% from the previous year, while in the affluent Changning district, prices fell by about 6%. Prices in Jing'an district in the heart of Shanghai fell by about 8% year-on-year. The key factors driving this decline are regulatory policies and an increase in luxury home supply, with an undercurrent of affluent individuals retreating from the market. According to the official website of the Beijing Housing and Construction Commission, as of the end of May, the volume of second-hand house transactions in Beijing fell sharply by 13% month-on-month to 12,100 units. The bargaining power of buyers have been robust, with a deduction of 500,000 yuan directly from the transaction price of similar properties in the past. Listings for second-hand houses in Beijing have also exceeded the average of 100,000 units per month, reaching 121,800 units. However, the number of home buyers is scarce, with only 2 to 3 people visiting a property listed in April in Beijing's East Third Ring each month. The question arises, if property market in Beijing and Shanghai are so sluggish, it is highly likely that house prices in most other Chinese cities are even more bleak. Recent data released by China's Bureau of Statistics further revealed this trend. In May, the rise in new house prices in 70 large and medium-sized cities in China slowed down across the board, and second-hand house prices generally turned to a downward trend. The data shows that only 46 of these 70 cities saw an increase in new house prices, 16 fewer than in April. Conservatively, the number of cities where house prices fell increased from 7 in April to 24 in May. In the second-hand housing market, only 15 cities saw price increases in May. 21 fewer than in April, the number of cities where prices fell accounted for 80%. This trend is also reflected in the latest house price data from 100 cities nationwide. The number of cities with a reduction in both new and second-hand house prices increased significantly year-on-year and month-on-month. There are 54 cities where the price of new homes fell month-on-month, an increase of 10 month-on-month and 9 year-on-year. In the second-hand housing market, there are 83 cities where prices have fallen month-on-month, an increase of 7 month-on-month and 26 year-on-year. The downward trend in house prices is already very clear. For example, house prices in Hangzhou, a city where internet giants are concentrated, have seen the largest drop in history, with price drops in some areas even exceeding 50%. The average house price in the entire city has plummeted nearly 30% in just a few months. Second-hand house prices in Beijing and Shanghai have all fallen. This phenomenon has not appeared for a long time. People's focus has turned to the market-saving measures that the policy may take, and whether this will reverse the decline in the property market. Goldman Sachs have made an L-shaped prediction, believing that domestic house prices will fall to a certain extent. The government will save the market, and then house prices will not rebound, but will remain stable for 10 years, slowly digesting the housing bubble. The Chinese real estate market, which experienced a 4 trillion yuan stimulus in 2008 and a shanty town renovation plan in 2015, is currently undergoing a significant downturn. The massive stimulus program under Wen Jiabao's administration led to widespread wage growth, which at times outpaced the increase in housing prices. However, following this influx of funds, an average price of housing in Shanghai began to slow in 2012. From a cost of 14,000 yuan per square meter, prices gradually increased to 16,000 yuan by 2015, with an increase of just 2,000 yuan per square meter for new homes over 4 years. During this time, the prices of second-hand homes were in decline. In 2015, China launched its shanty town transformation plan, further accelerating house prices. However, this time, the pace of housing price increases outstripped wage growth, amplifying the real estate bubble. Following a peak in 2018, housing prices fell continuously for 2 years until the event of the COVID-19 pandemic in 2020. The current downturn in China's housing market has led Goldman Sachs to predict an L-shaped trajectory. Some economists believe we are at a turning point, with housing prices now on the decline. The future direction of the real estate market would depend on whether measures are implemented to rescue the market. If no such measures are put in place, it is anticipated that the fall in housing prices will intensify. Experts point out that to stimulate the current real estate market, reliance must be placed on policy adjustment. Income growth alone would be highly challenging. If the objective is to drive housing prices by increasing income, it would be necessary to raise wage levels and increase the number of high-paying jobs. This could restore confidence in the housing market and boost transactions. However, given the current state of the internet, real estate, and finance sectors, where layoffs and pay cuts are prevalent, the path to market recovery through income enhancement is fraught with obstacles. Measures such as reducing down payment ratios and lowering interest rate could indeed be beneficial. For instance, many will be able to afford a down payment of 50,000 yuan on a 500,000 yuan property if the down payment was reduced from 30% to 10%. The current issue, however, lies in the instability of domestic employment. Foreign banks can afford to accept a 10% down payment due to relatively stable working environments in their respective countries. In Japan, for example, one could usually maintain private sector employment until retirement unless serious issues arise. In China, however, the employment situation is far from stable, and if a bank approves a high loan and then the borrower becomes unemployed, the bank would have to bear most of the pressure. As such, it is unlikely that Chinese banks will accept a down payment as low as 10%, similar to those offered by foreign banks. The world is now watching to see whether, following the People's Bank of China's interest rate cuts on June 20th, more lenient policies will be introduced at the end of June. If not, it is likely that China's housing prices will continue to decline. Based on last year's real estate data, both the sales area and volume of new homes significantly declined, hitting historical lows. Today, Beijing and Shanghai's real estate markets are experiencing a slump in transactions. If this continues, it could trigger a series of adverse effects, potentially causing a serious blow to China's economy and financial system. Firstly, as property prices continue to fall, a large number of homeowners may decide to sell their properties, potentially triggering a widespread selling frenzy. This could result in an oversupply in the real estate market, pushing prices down even further. Secondly, the decline in property prices decreases the value of homes that have been mortgaged to banks. Banks may then require homeowners to provide more collateral or increase their loan amounts, thereby increasing the burden of loan repayments. However, given the current economic climate, many individuals owing to salary cuts or job loss may be unable to repay their loans, leading to a wave of defaults. According to conservative estimates, by 2023, China could be grappling with a staggering number of 40 million residential property defaults. Out of these defaulters, more than 200,000 have already been sued by China's big four banks: Bank of China, Agriculture Bank of China, China Construction Bank, and the Industrial and Commercial Bank of China, just in the first quarter of this year. All these cases concern properties that have failed to reach completion, not counting other scenarios of default. In theory, every property developer behind these unfinished construction can be classified as defrauding the system and should be brought to justice. These developers have sold properties off-plan, pocketing the money without delivering their homes as promised. This quintessential form of fraud sees them taking money under the pretext of selling property, only to use these funds to plug other financial holes with little to no consideration for future property delivery. However, no such action will be taken against these developers in China. This is primarily because local governments are resilient on these property companies for land sales, perpetuating their narrative. If developers were to be prosecuted, it would deter others from land procurement and housing construction. As a result, these developers roam free, leaving those hardworking individuals who have paid their money yet see no property to bear the brunt. Once these defaulters are prosecuted, their properties will be auctioned off. These are known as foreclosure properties. From January to April this year, the number of foreclosed properties across the country reached 146,500, a year-on-year increase of 22.5%, but the transaction rate was only 26.9%, a decrease of 4.6% from the previous year. Experts believe the increase in the number of foreclosed properties and the decline in their transaction rate underscores China's widespread and serious debt issue, suggesting a severe deterioration in its economy. A substantial volume of bad bank debts would reduce liquidity, making it difficult for banks to provide loans and financial support to businesses and individuals as usual. This could result in companies being unable to acquire the necessary funds for operations and expansion, possibly exacerbating unemployment rates. Meanwhile, the impact on individuals may also be significant, potentially preventing them from securing loans to purchase homes, invest in education, support dependents, or meet other life necessities. The persistent downturn in real estate market has had a significant impact on related industries such as construction, furniture, and building materials. Revenues and job opportunities in these sectors are likely to be affected. Rising investor panic may lead to violent fluctuations in the stock market, resulting in substantial economic losses. With decreasing purchasing power, the retail and service sectors may take a hit, with businesses potentially facing the risk of layoffs or even bankruptcy. Adding to the burden, China currently faces economic sanctions from developed countries, resulting in a contraction in foreign trade income. Many businesses have seen a significant reduction in orders, leading to large-scale unemployment domestically. More people are losing their stable source of income, unable to afford high mortgage or rent payments. They may need to sell their properties, which could lead to an increase in housing supply and further depress prices. Hence, it can be asserted that the drop in housing prices in major and many other cities has engendered profound pain and confusion among the populace. Countless individuals find themselves in immense economic stress and psychological strain. People, in their desperate scramble to survive and fulfill their basic needs, lead to an erosion of social trust and ethics, and a gradual crumbling of social cohesion and unity. Today, real estate investors are finding their purses thinning, and property developers are increasingly falling into financial difficulties, some even tethering on the brink of bankruptcy. Behind this predicament lies an unassailable structural problem in China's economy that the government cannot evade. Contrasting the Western nations, which drive their economic growth by leveraging technological innovation and industrial development, China's economic surge primarily pivots on speculative behaviors in the real estate market. This speculation is fueled by a tactic collusion between the government and property developers, pushing up property prices and ruthlessly exploiting the general public's mentality of safeguarding their wealth through property investment. In the quest to secure a home, numerous families have exhausted their resources and shouldered weighty mortgages, but the tidal wave of property sell-offs have plunged them further into hardship. China's economic growth model, with its excessive reliance on the real estate sector, has amassed significant risk and instability.